Hey guys, David Robinson here. Welcome to the apartment investing journey. Really excited about our episode today. We've got another great guest for you. We have Dennis Shapiro with us. Dennis, how you doing today?
David, thank you so much for having me. Really excited to be here.
Yeah, my pleasure. Dennis began investing in real estate in 2012 when the market was just beginning to recover from the global financial crisis. He built a cash flowing portfolio, including many alternative assets such as notes and ATM funds, mobile home parks, life insurance policies, tech startups, industrial property, short term rentals, and more. He co founded an investment club for accredited investors in 2019. Following the success of his investor club, he launched SIH Capital Group, which provides accredited investors with a simplified strategy to invest for passive income. So, Dennis, we're excited to get into the conversation with you today because of the experience that you've had investing in a lot of different asset types and classes. But before we sort of dive into your specific investing thesis as it is today, our podcast is all about the journey. And so we'd love to back up and hear about this journey that you've been on over the years. And if you don't mind, just tell us where it all started for you and let's go from there.
Sure. So it started actually when I was 14 years old. I got a copy of Rich Dad Poor Dad from my oldest brother. We have a family where it's like if you find something good, you have to like kind of brainwash the other people to think in the same way. So I was 14 years old. I read the book and I was like, hey, you know what? I think the guy makes more money from his talks and his book sales than when he actually talks about. I was really cynical,
Sure.
complete 180 later on in my life. But I did get one thing out of the book at that time. I reread it, got much more things later on. But when I read it the first time, I was like, you know what? I should buy these things called assets. And I looked at, hey, I think I had $1,000 saved up for my part-time job. I said, what can I buy? And then obviously I went towards like stocks and mutual funds. At that time, I'm old enough to remember when you actually had to pay for a trade. And I went to my oldest brother. I said, what do you think I should do? He's like, oh, I have this great mutual fund, blah, blah, blah. And it was a terrible investment. I bought it, held on to it for like a year. I think it only went up $7 for like the whole year. So I literally like broke even. And then I was like, you know what? I think I could do this in a better way. So I started looking into more stock picking and picking my own type of portfolios. And I thought I had a really good niche in it. I was really progressing and getting better and better. I was outperforming the market. I was going to went through high school, went to college for a business school with the whole intentions of just being a stock, fund manager. And
Mm-hmm.
then I went right into the global financial crisis, and there were internships I was interning for. I mean, there was internships I was going for, and like the companies would go out of business by like the second and third round of the hiring process. So at that point, I had to pivot. I went for my MBA, and while I was getting my MBA, I got recruited by the government, and then I got my first paycheck, and I was like, wow, it's great. They're not only my employer, but they're also my business partner with the amount of taxes they're taking out. And I went home that day when I got my first real paycheck, and I Googled, how do I pay less taxes? The first time the results were semi illegal. So I went back and actually had to refine and say, how do I pay less taxes legally? And I got, the number 1 through 10 was all real estate. So then I did what every investor shouldn't do. I called up my big brother again. I said, hey, you have a small rental portfolio. Is there anything you want to sell? And he's like, oh, yeah, sure. And of course, he sold me his crown jewel. So I ended up, buying an overpriced low income a low income house that I really cut my teeth on. And I knew I didn't really want to scale that model, dealing with the evictions and dealing with the housing authorities and everything like that. And I was like, okay, what can I do? I was happy at that time with working for the government. What can I do besides that? And then I went down a rabbit hole where I started doing notes and note funds and
Mm.
ATM funds and life insurance policies. And then I kind of stumbled onto syndications. And that's kind of where I would say like my life changed at that moment. Once I got into syndications and I realized that I could be doing this, I could be getting all the benefits of the larger properties, but with a smaller amount. I was hooked. And then from the syndications, I learned about apartment buildings, but then I went to self storage and mobile home parks, and basically everything. I call it like the gateway drug because once you got into apartment building syndications, they transcribe so well to the other different asset classes. So I'll stop there because I know that's a
Yeah.
handful, and I
No,
could
that's
kind of
awesome.
dive in anywhere.
and very entertaining description of your journey. I love that, and I bet you've gone back and thanked your brother many times for selling you that gem of a property. So, well, this is great. So, how were you introduced to syndications?
So I was introduced to syndications, I think, from the Bigger Pockets podcast.
Mm,
So I did a note fund early on, and I liked it, but I didn't really know the difference between a note fund and the syndications. And then I kind of stumbled on because a few of the podcast guests on Bigger Pockets were talking about, how they were raising money from investors. So I was like, oh wow, this is novel. This is great. They're on this podcast and they obviously know what they're talking about, right? So I went on and I found them and I looked for ones that were local and
mm,
then that I could actually go and meet in person. And even though they weren't syndicating locally, I did just want to have that handshake conversation with them. One thing from working with the government is I interviewed probably like 10,000 people in the course of my career. So it allowed me to really get a good sense of that handshake conversation to feel if there's anything, shady is going on. And that's kind of
mhm.
how I got into syndications. And then it kind of just
Just for context, what did you do for the government?
I worked. I don't really want to. I don't really get into the specifics of it because I'm still technically currently part-time employed there. Uh,
Okay.
but basically handled some of the retirement, like I guess consultancy in, in regards to that.
Hmm. Interesting. All right. Okay. When you're completely out of that job, come back and tell us what you do.
Yeah, no problem.
All right. So let's move forward, and then I want to bridge the gap. So, what does your business look like today, and what do you focus on?
So today, SIH Capital Group is my main core business. So we run an income fund where that allows the accredited investors to get a fixed return. Our specialty is that we have a higher cash on cash from day one, and it's just a much more simplified process. Now, we also allow our investors to individually invest in specific deals as well. So you can
Hmm.
kind of complementary make a portfolio. You could have a fund that actually focuses on income, and then you could invest in individual deals to get that broader total returns projection. So that's kind of our focus is individual deals, and then we have our income fund.
Okay. And do you focus on a particular asset type at this point?
Yes. So in terms of the specific deals that we offer our investors, it is we're in the affordable housing space.
Hmm.
So that's a very niche market because the buyer's pool is generally a lot smaller for affordable housing, especially when you're talking about like LIHTC, like low income tax housing credits, and they require certifications from the state, and they require you to have a good base on understanding how the voucher system works and what you can legally charge, which you can't, what fees you could charge, which fees you can't. So those complexities are really a great barrier of entry for a lot of operators to get
Hmm.
into. So it allows you to, I would say, get a better deal than if a deal goes into the market and gets bid on by 20, 30 different operators out there.
Yeah. And just to back up real quick and to add some context to the income fund, describe for us the difference between sort of the traditional syndication and the income fund, and how do those work for from a passive investor perspective?
Sure. So I'll kind of first back up and say why I created the income fund in the first place. Um, like I mentioned in my bio, I have about 20 years of investing in stocks, and I'm one of the few investors out there that's in real estate, but also has a sizable stock portfolio because I think there's a lot of advantages to having both. But the one thing that I could never get out of my stock portfolio was the income. Like I
Hmm.
tried every single income strategy that's on the stock world, like the REITs and the MLPs and the utility funds, and none of those strategies ever worked because once there was a small downturn, all your yield would get wiped out. So I created the income fund because that was kind of the product that I was looking for, almost like a REIT that's not publicly traded. And that's what I kind of devised. And the way that the income fund works is there is no back end return. So it's a flat seven, but it's a flat seven from day one
Mm.
because we have we're invested in close to 196 different properties through our different operators that we picked in. So it's very diversified. Basically, our investors get almost all the returns for the first couple of years, and then the back end is our profit. So it's a very unique fund out there because its core focus is to create that higher cash flow from day one versus other funds. What you will end up getting is you'll end up if a deal is invested in, let's say, one apartment building, what ends up happening is that first year the cash on cash could be 4, 5, 6%. So your cash on cash doesn't catch up to your preferred until a few years later on. But the way that I did it, by having a strong portfolio already in the fund, I was able to pay that 7% basically. So the cash on cash actually equaled the pref from day one.
Gotcha. And the 196 roughly properties that you've invested in through that fund, are those also affordable housing, or do you have different asset types that you focus and asset classes that you focus on in that fund?
The income fund is much broader. The deals
Mm,
that we syndicate is the affordable housing, but the income
hmm
fund is much broader. We do general apartment buildings. We do notes there.
mm,
We have a blend of basically appreciating assets and assets that focus on cash flow. So it's
gotcha.
more than just affordable housing.
Yeah. And so as you have these two, which I love the strategy of having both options available, right? And you see a lot of sponsors that will go with a two-tiered class of shares in their syndications where they offer maybe a 10%, or 8% clip on a monthly basis, but no upside on the back end, and then someone that's participating on both a little bit of the cash flow and on the front end, but not a preferred return. So I love that strategy of having both of these available to your investors. What do you notice from your investors as to their preferences? Who do you see investing or wanting to be a part of the income fund versus your one-off syndication deals?
So I think it's just timeline and perspective. Like the income fund is better towards people approaching retirement because to get a fixed, basically 7% return is attractive to those people. People that just started out in their careers, they don't want to hear 7%. They want to be, they want the 15, 20 plus returns. So I think it's just about where they are in their financial goal. And or it'll be someone that already has a well-diversified portfolio and says, you know what, it's good to just diversify into another well-diversified fund. So usually
Mm-hmm.
those are kind of the two investors that I would see that are attracted to the income fund, but it's mainly people who are looking for that higher income from day one and with a capital, and they see the security in how the fund is structured.
Yeah. And so, you've done a lot of investing, 196 different, properties inside of the income fund, and then your syndication deals as well. Are you acquiring these as the main sponsor? Or, how do you structure these deals? Are you out there hunting out deals, putting deals under contract, acquiring them? Are you coming in a little bit later in the process and bringing your equity to the table along with some other duties? What do you do? How does that work on your end?
So the income fund, obviously, because of the sheer number of properties that we're invested in, that's basically all as a limited partner. The deals that we syndicate, we're literally day one type
Hmm.
operators where
Okay.
we are partnering. For example, the affordable housing property that we're closing on next month, my partner toured that day one, like the same day that the broker was touring it for their broker's value opinion. And we've been involved in that project every single step of the way.
Gotcha. Love it. Well, that's a good segue to talk about this 50 unit deal that you're closing on. I know that it's not fully closed yet, so we'll talk at a little bit higher level about the deal. But if you can, just describe the asset for us and generally what market it's in.
Yeah, so it's located in Pennsylvania, about 30 minutes south of Lancaster. It's a smaller market, but it's actually a really interesting market because the town itself is surrounded by farmland. So there's not many apartment buildings in the town, but the population has been pretty consistent. So it's like sometimes you'll see a deal and it'll be like at a 10 cap listed by these brokers, and then you'll see the population and it's like a slow decline down to
Mm,
like almost like the town is dying.
mm,
This town actually is it's like a feeder town to Lancaster into Philadelphia. So it actually has a pretty strong population. Like the population has grown from I think it's like 4,500 to almost 5,800 in the last 10 years, and it's been more or less a straight line. And inside the town, there's only 2 or 3 apartment buildings, and my partner owns one of those, and we're going to be buying the other one. It's all from the same developer, and that's kind of our unique niche on this, is because this is not an on-market deal. We're buying it from one of the largest affordable housing developers in the state and in the country, and we were able to just get we had that open line of communication with the director of what is it? The director of like sales disposition, the director of disposition. So we were able to kind of negotiate with him every step of the way without any like middleman interference from some of the brokers. And that's why we feel like we got a pretty good deal. We came in under what the BOV lowest target was. So we feel pretty good about this deal.
And so, going back to that relationship and your partner owning one of the other buildings, was that building bought from this developer as well?
Yeah. Yeah.
Okay.
So that the beauty of this deal is that it's literally a mirror image of the deal he bought from them 3 years ago. And it's literally the same seller, same property management. It's the same business plan too, because they run slightly higher operating expenses. So it's more of a expense play than an income play. But it's literally, we're going to plug and paste what we did here 3 years ago to what we're doing here today.
And this is an affordable housing deal. So, for our listeners who sometimes affordable housing is used sort of a blanket statement as sort of to describe a property that's C class. But when you're talking about affordable housing, you're talking about a particular niche in this space. Maybe just describe for us what, your definition of affordable housing.
Yeah, that's a great point, because when I bought my first single family rental from my brother, technically it was affordable housing and it was Section 8. But if you look at that property and you look at this 50 unit that was built in 1998 and looks like they're beautiful townhouses with private parking, and it's almost like a gated private community. It's a much nicer looking finished product than what you're dealing with on if you're in a low income area. So this is a blue collar area, and it's a really, really nice property. Now, what makes it affordable housing is the developer, when they built it, they received a lot of tax credits to get that property up and running. Now, more or less, the tax credits are kind of going away, but everybody in the building has some type of reimbursement from the government. So the way it works is, in the state of Pennsylvania, I don't want to make broad statements for the whole country itself, that we have project-based vouchers, tenant-based vouchers, and we have just utility reimbursement. That's how this specific property is set up. So what's unique about it is, you think vouchers and vouchers are apples to apples, but they're so completely different. So when you're dealing with a project-based voucher, that voucher stays with the property and is assigned by the county. And what ends up happening is you almost have a lot of leverage over the tenants, because what happens is, if it's a bad tenant and they're not following the rules of their lease, you could evict them and they will lose that voucher, because the voucher is staying with the specific property. So they could go from, getting rents as low as, let's say $600, $700, $800 to having to go find something market value. Now, tenant-based vouchers it goes with the tenants. So a lot of it is just trying to focus really on expanding your project-based vouchers, because that'll give your property manager an upper hand on that stuff. So we have about half the units are just project-based vouchers and tenant-based vouchers, and then the other half of the units just really get utility reimbursement. What's good about that is that it makes it easier for our tenants to pay, and then with the combination of the vouchers, it allows us to get a huge wire coming in, like the first of the month type situation. So we're not in day 7 and chasing down our tenants for half the rent or whatever it is.
And so describe for us maybe some of the pros and cons to investing in this type of project, like a true affordable housing project where you are getting, whether it be project-based, tenant-based vouchers or utility reimbursements. Like, what are the pros and cons to investing in a project like that versus maybe like a C-class, asset that still is, like workforce housing, but not necessarily affordable housing?
Sure. So I would say the main benefit is, if you have a property management team that knows the nuances of affordable housing, because that's the first step. Once you get past that step, the pros are is that you have usually a more higher occupied property. For example, the property we're purchasing at, the occupancy has fluctuated between 98 to 100%. So if you look at the typical Class C value add property, usually you're supposed to budget for, let's say, 5 to 10% vacancy, and then 5% to rental delinquencies. So you're at a 15% rate. Versus in affordable housing, not only are we at 98 to 100%, we also have a waiting list already given to you by the town. So we don't have to go and market or anything like that. So it's just a much more stabilized product from day one, and it's a much less complicated build it. Like I like to say, a lot of value add these days are like build it and they will come model. It's like, oh, we're going to take this property and we're going to put the luxury vinyl plank and floors, and we're going to, spruce up the kitchen, maybe paint the cabinets or replace the cabinets. And then voila, we're going to get another 175 a month. And it's like, fingers crossed, we should be able to get it. The market's super strong right now, blah, blah, blah. Versus our model is more about, we already have the occupancy. So it's not about going in there and trying to increase the rents by $175, $200. We're just going to efficientize the operations. For example, the previous seller had their own property management company. And their own property management company was charging double the rates of what our property management company. But they don't really mind because it's their property management LLC. So they're paying from one hand to another hand. But for us, that's day one savings for our NOI. So it's a whole bunch of these things where the focus is on cutting stuff that you can day one versus having a renovation plan and hoping that the market will fill in based on that renovation plan.
And typically, how long are these projects sort of, because you do have some income restriction, right? You have some caps at how far you can take the rents. Is that correct?
Yes. There's adjusted medium income, and some of your properties have to be 50 or 60% around that area. We're okay because we're right around there, and so we're not really. That's not really an issue. For some locations, that really plays a huge role. But where the median income is in line with that, it's a lot easier. But it's just something our property management has to be careful about screening in and making sure we have the right balance of those tenants that are in there. But again, that's like another layer of I guess complication, bureaucracy to these type of deals that scares a lot of the buyers away.
Yeah, absolutely. And I can see that being a distinct advantage. Having that, niche market knowledge is definitely helpful. So how long do these projects get tagged as low income housing? And if does that ever fall off? And if so, what's typical?
Yeah, so I think it does depend on states. I've seen situations where it's 30 years. This specific situation, it was only 22 years, but they just renewed the contract last year. So I think we have another 20 years for the contract, but it's okay because we are getting fair market rent anyway. We're actually getting a bump up from the fair market rent. So there's no incentive. Sometimes the way that these contracts work is that you have to sign it such below market rent. It makes no sense for it. But in this situation, we're actually getting a premium. And it's not like if we switch from this model, we could turn around and start getting people in there for $1,800 and the apartment's only $1,200 right now. So there's really no incentive to switch. Instead, we're getting like a $50 bump up for it to be all affordable housing.
Gotcha. Yeah, I'm aware of a few projects that were tagged as low income housing, but it was about to fall off, and that was part of the business plan, was to go in and acquire the property a year before this restrictions drop off, and then to really ramp up rents from that perspective. So I was just curious if that was ever part of your business model, but it sounds like that's not it. You're really looking to operate these at a high level.
Yeah, and we plan on keeping them affordable housing. That's all part of our business plan. And I'll tell you the other biggest pro, and I would fail me if I didn't mention this, is when we're working with Freddie Mac on this, with the agency providers, we get like expedited treatment because it's affordable housing. So not only are we getting a reduced rate on our interest rate, we're getting about 50 basis points lower than the market rent. We're also getting the deal expedited where we're not on the same waiting list as other operators are. So that's the other big pro on this deal.
Yeah, absolutely. Well, is there anything else that we should discuss as it relates to affordable housing that would be helpful to our listeners that I haven't asked you so far?
Yeah, I think it goes back to the fact that there's a lot of operators there that are doing value add, class C, class B, and everything like that. But there's not a lot of operators out there syndicating affordable housing. It is a
Mm-hmm.
very, very unique niche, but the niche has a lot of unique characteristics. Like when we were raising money for this deal, by just mentioning that it was affordable housing, we like piqued a major interest from day one. So just for investors, that this is very different than investing in just a traditional Class C asset. Affordable housing is its own monster, but that also means it could serve as its own distinct niche in an investor's portfolio.
Yeah. And so, as you were going through this deal, and we're going to be a little bit high level on it, but what were some of the, what went well during this acquisition, and what was a challenge that you faced during the acquisition?
Challenge. Okay, so what went well is having that direct line of communication from day one, and it
Mm,
wasn't. It was such a partnership type mentality because this is a second deal. We're working with the specific seller on, and we potentially have a third one after this. So we wanted it to be as amicable as possible. So there was very little pushbacks on both sides, and it was just a lot of just logic and common sense. And even when we found certain things in due diligence, like we're in a market where honestly the seller really has no incentive of coming down on some of these items, and they still worked with us and they still gave us, like, I think we got like
mm,
another $75,000 price cut the last, and because of due diligence. And it was just really, really went well in terms of not having that commercial broker in the middle. And we weren't waiting days. There were just problems were being solved the day of. So it was really an excellent experience from that end. What didn't go well is during the process there was an accounting, one of the voucher programs. It was their property management software was incorrectly charging one of them, which
mm.
caused a huge flux in the middle of the due diligence period. It was resolved, but just because it's the voucher program and each voucher program has a very specific what's being paid out by who. And if there's a $35, $40 difference, it causes havoc. So that definitely, I would say, didn't go too well, but it was eventually resolved.
Yeah, yeah, sounds like it. And so, what's the game plan once you close? What's the first few things that you guys stepping into ownership? What do you guys do?
Yeah, so first few things we're doing is we're putting our own property management. Our property management company has 38,000 units under their belt, but more importantly, they have a low income housing division within the property management. And that's really important. If you're ever investing in an operator in the space, which property management are they using and do they have affordable housing experience? Because you do not want your Class A, Class B property manager trying to run one of these things, especially from a certification perspective. So day one, we're putting in our property management. Same like day one, day two, we're getting a utility conservation company to come out, replace all the water fixtures. We're already getting quotes on that right now, so that could start day one. Their water expenses are pretty high. We are also going to be implementing a pet fee because the current leases you're not allowed to have pets, and during due
Mm,
diligence, almost every single apartment, because they're like townhouse and they have a very homey feeling to it. Every single apartment had a pet in it. So we want to maybe even embrace it, put a little dog park, and actually start charging the tenants for pet fees. So there's a couple of little things that we're doing. The main thing is just the expenses. We're going to be cutting down expenses. I think we have it something like budgeted to cut down about $140,000 worth of expenses in year one, and most of those could take into effect like day one type of
mm,
situation. So that's our basic game plan on this. And the financing we got for this deal is a 10 year, and we're going to be looking at like between 3.1 and 3.3
mm.
when we lock in like a week and a half to 10 days. And it's if the inflation stays at 5.6, we'll hold it for those 10. And if inflation calms down a little bit, then maybe this will be a 5-year hold. But
Yeah,
we wanted our investors to go in with understanding that locking in 10 years fixed low interest debt right now is probably number one, number two thing every operator should be doing for their investors.
Yeah, absolutely. Well, look, this has been a great conversation. I've really enjoyed hearing about, your background and how you even got, started in the real estate investing space when at a young age, 14 years old, grabbing the Rich Dad Poor Dad book, getting that from your brother, and then, him doing you a solid and selling you his sweet property a few years later. And then your experience, in the stock world and investing in a lot of different asset types and ultimately, working for the government and realizing, my goodness, I'm getting hit pretty hard from a tax perspective here. How do I minimize that? And transitioning into multifamily or in real estate in general to try to minimize some of the taxes that you were paying, and ultimately into syndications. How you've created the income fund and the one-off syndication to give your investors some options there. I want to start winding down here, Dennis, and I got a few final questions for you. The first is, what's the biggest challenge that you're facing right now in your business?
So I'm at that unique growth stage where I still could tackle everything myself, but it's getting to the point where I'm not going to be able to do so. I use VAs, I outsource everything that I can potentially outsource. But definitely the challenge is just building out a team, because I have partners, but those partners, we're not the same company. So actually building out my own team is probably the biggest challenge right now.
And what do you see as your first step to go that direction?
I just need a little scale at this point. So once we get to the point where we not only have one income fund, we have two, three of them, and we don't do just two deals this year, we do four or five, then it'll kind of pay for itself.
Yeah, great. What's going really well in your business right now? What are you absolutely crushing that we could all learn from?
Strategic partnerships. It's been something I've been working on for 2, 3 years. I'm really big into networking, and the deal that I got with affordable housing, that was someone that I took a road trip with for like 8 hours for a real estate investor group. Never met the guy in my life. We had so many different similarities, but after that trip, we were talking once a week. And, I got to know everything about him. He got to know about everything about me. And it was just, hey, come out to see this property with me. And we've been working on ever since. And same thing with the other property I've been working on. It's just strategic partners. It's having a really good sense of will it be a good fit, because it's more or less a marriage at that point if we're going to be working together for the next 10 years. So, going through the due diligence process and contract negotiation, everything like that, I've just been blown away how good my operators are. I mean, my partners are, where I'm fortunate enough to say they're way, way smarter than me. And I'm blessed with that.
Yeah, love it. Well, Dennis, this has been a great conversation. I appreciate you sharing, the insights around your journey, and also specifically affordable housing, and getting into some of the weeds on that and giving us a better sense of how those deals are taken down and some of the nuances in there. What's the best way for our listeners to connect with you and learn more about what you have going on?
Sure. So this year, I published a book, The Alternative Investment Almanac, Expert Insights on Building Personal Wealth in Non-Traditional Ways. It basically goes over a lot of asset classes that I went through to get to syndication, especially the note funds and ATM funds and life insurance policies. So if your readers might find that interesting. And then the best place to actually reach me is through my website, sihcapitalgroup.com. On the site, you'll find two abridged versions of my book, where we discuss some of these asset classes with investors that are really, really well known in the space. And I did abridged versions for the content, and then I did abridged versions of the Q&As. So feel free to download them and reach out.
Awesome. We'll have a link to both of those in the show notes, sihcapitalgroup.com, as well as Dennis's book, The Alternative Investments Almanac. Dennis, a pleasure to connect with you and have you on the show. Thanks for sharing your journey with us, and I look forward to connecting with you again soon.
Thank you so much for having me.